Hello, everybody. Welcome to Wednesday. The S&P 500 was down 0.8% today. Really, what we're seeing right now is the effect of what the Federal Reserve is trying to accomplish starting on Friday, which is really to bring down the value of the stock market and increase the yield on bonds, both of which could help them with their fight against inflation. And so today we had another Fed president doing an interview, and she mentioned that she expected that the Fed funds rate could be over 4% in next year. The market isn't thinking that that's going to happen, so obviously that's a negative overall for the market. She also mentioned that she didn't expect there to be any rate decreases in 2023, and again, that's not what the market has been expecting either. So maybe the market will be right and the Fed will be wrong, but in the interim here, the Federal Reserve is going to continue to fight against these runs that we're having in the stock market. It's a very powerful, influential group because they control, essentially, the things that the stock market needs to really get its growth and get moving as far as that goes. So, the one time that they kind of talked a little bit more reasonably in June, the market really took off. And so I don't think we'll be hearing that anymore, too. So this is, in my opinion, a time to be cautious just because we really don't want, there's a saying, don't fight the Fed, and this is what they're talking about. And so, again, we had one of our pieces in our model trigger yesterday that we moved into a T-bill ETF. We have several others that are close to triggering, so we'll continue to kind of just get a little bit more conservative. We'll come back in if things get better. Hopefully, we do see some run up tomorrow and the next day and what have you too, so we'll see how this plays out. But so far, the Federal Reserve is kind of winning this battle, and we'll just have to see how this plays out. I do think over the longer term, the data should win out, but the data isn't completely clear as to what's happening yet either, because although we're seeing commodity prices come down, like the price of oil was down today, we're also seeing a very tight labor market with the number of job openings that was much higher than expected yesterday. And then, of course, the job report for how many jobs were created last month comes out Friday. And so we'll see how that plays out. Last time it was quite high. And again, so we got a tight labor market that maybe is going to create, more inflation because people need to get paid more in order to attract them into the workforce. And so that's the battle that's happening right now with inflation. And really, in the end, the Federal Reserve is probably not going to back off on both raising rates or, their heavy rhetoric until they see a lot more progress. We are seeing progress, but, there's probably more that they need to see before they're allowing the market to kind of free run without their, interference as far as that goes. So it's a little frustrating to see how this is playing out, but it's a part of the process. There will be a point in time here where this market gets too low. Could be already, and maybe it'll be something lower than this. We'll have to see how that plays out. And then things will probably start to really run. I know in 82, looking back at that, when they were fighting inflation, once they kind of got done with that, the market was up 106% on the S&P 500 in a 10-month period. So there's some, things that can happen to the upside very radically because there's an awful lot of earnings that are still happening right now, and commerce is still going on. We just have to get this inflation under control globally because it's happening everywhere, really, except for China at this point in time. So anyway, that's what's happening right now. I don't think things are that bad, just to be a little bit cautious as far as that goes. And, we'll wait and see and try to find, that point where things can start to take off. So look forward to talking to you tomorrow. Thank you very much.